Okay, so welcome to this quick tour video, which is number 1 in a 3-video series that explains use of the accounting spreadsheet that's available for download through the links in the description below. This video just provides a brief overview of the spreadsheet so you can assess whether or not it might be something that you would want to use. Video number 2 is a description of the accounting principles that apply to the spreadsheet. So that's basically double entry accounting and the accounting equation. If you're familiar with those principles, then you could probably skip video number 2. And then video number 3 is a detailed overview of use of the spreadsheet. That's a pretty long video. It's over an hour long, but it goes through entry of various types of transactions into the spreadsheet and gives a detailed explanation of how to use the spreadsheet. So if you think you're going to go ahead and use it, you should probably watch video number 3. And I'd say especially if you find this quick overview video a bit confusing or maybe even a bit intimidating, then if you watch video number 3, you'll see it's explained in much more detail how the spreadsheet works, and hopefully that'll make it more understandable. So we should be clear about the goal and purpose of the spreadsheet. It's basically to record accounting transactions in a set of ledgers, and doing this by applying double entry accounting such that debits match credits, and then also to produce an income statement and balance sheet. These are the records that most small businesses would need for tax reporting purposes, and they'd also be very valuable records to have if a tax audit takes place. So this spreadsheet is not intended for large businesses which have hundreds of accounting transactions happening each day. Those organizations will typically have special software that includes invoice creation capabilities and check writing functionality, and also those organizations would typically have full-time bookkeepers that enter transactions in the records in real time as they happen every day. So rather, this spreadsheet's intended for startup or small businesses that have perhaps about 50 transactions a month, and for owners that are comfortable using Excel and in fact want to use Excel as a record-keeping system. It also anticipates month-end accounting work where the bank statements are used as a partial guide as to what transactions have occurred during the month. So again, this is a bit different than large organizations that have full-time bookkeepers, because where you have a full-time bookkeeper, the transactions are entered daily, and then the month-end bank account statements are used just to check those records that are created during the month. Whereas in a small business, you might have a situation where the owner waits until the end of the month and then enters the various transactions in the books of the business. Okay, so let's take a look at the spreadsheet. The spreadsheet has 4 tabs, and you can see them listed down at the bottom over here. And the first tab is the Ledgers tab. So that's where all of the transactions are entered into the books of the business. And it's very important to think carefully about what ledgers you want to have for your business. And all of the ledgers are listed on the Ledger Index tab over here. You can see that each of these items is actually a cell reference to the applicable ledgers as listed on the Ledgers tab, and we'll explain a little bit later why it's very important to keep this list of ledgers up to date. But as mentioned, the Ledgers tab is the foundation of the spreadsheet. That's where all of the transactions are entered, and then the income statement lists accounts from the Ledgers tab that should be included on the income statement. And again, these are included by way of cell references in column C back to the applicable headings on the Ledgers tab. And as well, the balance sheet lists the applicable accounts that normally are included on the balance sheet. And again, in column C, you've got references back to the Ledgers tab. And then, as I'll explain in a little bit, there are macros that bring in the applicable amounts into column D on the balance sheet. Okay, but let's go back to the Ledgers tab and take a look at what happens there in a bit more detail. As mentioned, this is the sheet where transaction data is entered in the first instance, and this spreadsheet does not use journals, but rather enters all transactions directly into the ledgers. The spreadsheet available for download through the description below does have some predefined ledger accounts, but you'd have to customize those as needed to suit your own purposes. The data included in the spreadsheet that we're looking at right now is actually the data that is described in video number 3 when a detailed description is given of how the spreadsheet works. But I'm going to go ahead and enter in just one more transaction as part of this quick overview video just to explain how the spreadsheet works. So I'm going to enter a $500 rent transaction. So before we do that, let's use the quick navigation tool up here to jump down to the rent account and see if there's any data entered right now in the rent account. We see that it's empty, but that's fine. The business is just starting out, so this will be the first transaction in the rent account. So I'm going to jump back up to the bank account over here and get ready to begin entering the new transaction. But before I do that, I should make sure that the spreadsheet is balanced. In other words, before going ahead and entering fresh data, you should always make sure that the data that you've already entered is correct. So things are looking pretty good right now. The debits and credits are balancing, and that's indicated by the green feedback over here. And as well, if we click the blue Update Ledger Refs button, we see that the balance sheet is balancing. I'll explain a bit more about that later on, but I just want to emphasize at this stage that before you go ahead and enter additional data, you should make sure that debits and credits are balancing and that your balance sheet is balancing. And I should note that when the debit and credit tallies are taken, those calculations only consider data that is on or before the date stated in cell D3 over here. So this spreadsheet contemplates that the user will export their monthly bank account transactions from their online bank account into an Excel spreadsheet and then copy them into the spreadsheet at the end of the month. So let's open up our hypothetical spreadsheet containing the dump of data from the online bank account. We'll take the $500 rent transaction for January 25th and we'll copy it into the spreadsheet on that date. Now one has to think very carefully about what sign, in other words plus or minus, should be entered before the amount. In this case, we know that the rent is being paid out of the bank account, therefore the bank account is going down, and that therefore should be a minus. We can also look at the cheat sheet on the top of the Ledger Index tab. It tells us that for asset accounts and expense accounts, a minus should be shown as a credit. And indeed, on the Ledgers tab, once we have a minus before the 500, it does show that the 500 is entered in the credit column. So keep in mind that the user will only enter data typically in columns D through F, because columns H through O actually have all programmed formulas which automatically enter the data into the appropriate columns. Once again, the formulas are there to be seen if you want to see how the programming works, but certainly users typically only enter data in columns D through F. Alright, but now that we have our first half of the double entry transaction entered, not only will you notice that the balance between debits and credits is no longer balancing, but in fact you'll notice that there's a $500 difference because that is the $500 we just entered. You'll also notice that there's a 0 in this column. This is the number of matches column and indicates the number of matching transactions that appear to be the other half of the double entry pair. And right now, there are none of them. Typically, you'll want to have 1s in this column, although having 2s or 3s is acceptable. Having 0s is unacceptable. And we know that, in fact, there's a problem here because we've got this red feedback over here indicating a lack of balance condition. So let's go ahead and enter the double entry transaction. How you do that is by selecting the amount you want to double enter and then clicking the yellow double enter button up here at the top. You'll see that that brings up a pop-up window that requires you to enter in the information for the double entry. At the top here is a summary of the transaction we're going to double enter, and then down at the bottom here we've got to pick either from assets, expenses, liabilities, equity or income accounts, which account we want to put the double entry in. So in our case it's going to be rent, and then we're going to put 500 effectively with a plus sign because rent as an expense is increasing. So keep in mind this list of accounts that we get to make our selection from is actually built from the list of accounts on the Ledger Index tab. So earlier when I said that it's important to keep the Ledger Index tab up to date, it's important so that this list is kept accurate. So even if you don't think you're going to use the go to account a quick navigation tool, which is up here, you should still keep the Ledger Index tab up to date so that this set of accounts over here is working correctly. So now that I've entered the data on this tab, I'll click the Go button, which will then bring up a feedback form, which shows me yes, debits and credits match. So when I entered the plus 500 for rent, that was a logical thing to do and did create a balance condition. And then down the bottom here, I can see a summary of the origin account, which was the bank account, and then also the rent account that the double entry transaction is going to be entered into. I'm going to go ahead and click the green button because it all looks good and I want to go ahead and put this double entry transaction into the ledgers. If I wanted to go back to the input form, I could click the orange button and change my selection. Or if I wanted to abort the transaction entirely, I could click the red button. But let me go ahead and click the green and send the double entry transaction to the ledgers. So now back on the ledgers, we see that debits and credits are balancing, which is good. If we wanted to view the double entry pair, there's a couple of ways to do it. The one way is to click the Go to Row button. The Go to Row button always jumps you down to the row that has a number that corresponds to the figure listed in column O over here. Because what's happening in the number of matches columns, it's looking up how many transactions appear to be the corresponding double entry pair. As we mentioned before, this was a 0, but now it's changed to a 1. So I can click the Go to Row button. It'll jump me down to the rent account, and I can see the double entry there. And if I want to jump back, I can click the Go to Row button. It'll take me back up to row 29. I can also click the pink message box button, and it'll show a summary of the two halves of the double entry transaction. The debit credit check only counts or considers data up into the date in cell D3. So I should always make sure that cell D3 contains a date that is on or after the date of the transaction I've just entered. And a quick way to do that is to click this green date button over here, and that runs a macro which automatically pastes the date of the row that I had highlighted into cell D3 and then checks the debit and credits balance. Now you'll notice that it's actually showing a red warning over here telling us that in fact it does balance. That's the green yes, but it's warning you that it's balancing a subset. And the reason for that is because this date is earlier than the latest dates all the way down this column. And in fact, we can see here there was a January 26th transaction, and that's why when this date is set to January 25th, it'll tell you yes, it does balance, but it's only considering a subset of the data. So if you wanted to be sure, you could click this January 26th date down here, then hit the green date button. It'll put January 26th into cell D3 and now confirms the debits and credits balance considering all data up to and including January 26th, which also includes these transactions down here, which were actually explained as part of video number 3. So debits and credits balance, that's a good thing. I also need to check that my balance sheet's balance, so I should click the blue button over here. What that does is it'll send the latest data to the income statement. You'll note now that it includes the $500 for rent, which wouldn't have been shown there before. And it'll also send the latest data to the balance sheet, which will now include this revised balance for the bank account of $5,285. And here we see it over here on the balance sheet. So basically, by clicking the blue Update Ledger Refs button over here, it runs a macro that takes the account end balances for all ledgers and sends them to the income statement and to the balance sheet. And it basically knows which account to send where because the user would have programmed in the cell references into column C on the income statement and into column C on the balance sheet. The income statement does show the net profit or loss, which in this case is minus 3,600. That data is brought into the balance sheet as is typical when doing an income statement and balance sheet pair. And in this case, it tells you, yes, assets minus liabilities does balance with total equity. And that's why we get a green feedback cell over here. And indeed, that's why there is green feedback over here saying, yes, the balance sheet balances. And yes, the balance sheet date matches the ledgers. Because what happens on the balance sheet is it looks at the date of the account end balances. Those get brought into column G. At the top of column G, you have the latest date out of all of these ledgers. And then the check that was happening on the ledgers tab makes sure that this date, which is the latest date of all the balance sheet ledgers, matches the date in cell D3. And says, yes, the balance sheet date matches the date on the ledgers tab. So basically that was an example of entering one additional transaction in a baby step, then running the macros to make sure that the debits and credits still balanced. In other words, we entered our plus and minus signs correctly, and therefore the transactions went on the correct side of the dividing line between the debit and the credit column, and we recreated our balance sheet with that new transaction to make sure the balance sheet's still balanced. And that's the idea of balancing in baby steps, which I say the spreadsheet is built around, which is especially useful for people who aren't expert accountants and aren't necessarily 100% certain of what should go in what account. So at least if you do it in baby steps like this, you can check each transaction as you enter it to make sure you've not made any mistakes. If you're more confident, you can enter a batch of transactions, but then you run the risk of having to filter through that batch of transactions to figure out where mistakes might have crept in. Okay, so that's a high-level overview of how the spreadsheet works. As mentioned, it's recommended that the users balance in baby steps using small chunks of data and then checking for balance condition after entering each small batch, rather than entering a large amount of data and then trying to struggle through to find the errors that are causing a imbalance condition. And also, a fresh spreadsheet should be started each year. In other words, you take the account end balances for accounts that typically have balances that carry over year, and you put those into the new spreadsheet, but you basically have a fresh version of the spreadsheet that you begin each year and enter your transactions afresh. So just the typical approach of having a separate set of books for each year. So although clearly this spreadsheet's not going to be suitable for every organization, I say it actually does have a number of advantages over some commercially available accounting software packages. So first of all, their calculations are transparent. In other words, the spreadsheet's not a black box and you wonder what's happening in the background, but rather the spreadsheet has macros to assist with data handling, but it leaves the calculations in plain view for the users to see. So there are quite a few nuances to the spreadsheet, so if anyone plans to use it, I would recommend watching video number 3, which is the detailed overview of how the spreadsheet works. And again, there are also written instructions through the link in the description below. And finally, if you find this spreadsheet useful, then you should like this video to improve its ranking and help others to find it. Alright, thanks.